How do you know which cryptocurrency assets to select for yield farming so that you can still get a strong APY every single year and not get wrecked? My name is Brandon, and I help people maximize yield in cryptocurrency investing, playing on the safe and reliable, low risk end of the spectrum. And today, in the next couple of minutes, I'm going to share with you a simple concept about how assets are correlated in terms of their price action that directly affects the potential for how much yield that you can actually earn. Let's dive right in. I'm going to share my screen. And to kick us off today, we are talking about correlated assets and yield potential. Now, what I want to highlight here is in the world of yield farming, there are wacky, wild promises, right? Oh, you can get 700% APY, 900% APY, all this crazy stuff. But the reality is, if you can land in the range of 50 to 100% APY every year on average, now that is separate from the appreciation long term of the base assets. I'm talking about just the yield and rewards that you get from yield farming. If you can land in the reasonable range of 50 to 100% APY per year, you are absolutely crushing it. So there's no need to get greedy and shoot for these wild, crazy 5, 6, 800% APRs or anything like that. We're sticking to reliable returns that are on the low risk end of the crypto spectrum. Now, what I want to highlight today is just a simple concept about how assets are correlated and how that affects how you set up your initial liquidity positions. So let me take you through. First of all, this is on DeFi Llama. Okay, so DeFiLlama.com/correlation. DeFi Llama, of course, great tried and true site, gives you lots of data and a great place to kind of do some research and explore the wide world of crypto. What I've done here is set up a very simple correlation matrix between some of the blue chip crypto assets. Basically, what we're looking at, it even tells you here, hey, the Pearson correlation coefficient. And you can research that if you want to go to Investopedia and look up Pearson correlation coefficient. It's basically just saying that there's a mathematical formula that evaluates how variables are related to one another. So in this context, we're talking about the value of different cryptocurrency assets. Those are the variables that fluctuate with the market. What we want to know is, do two assets more or less rise, fall, move sideways pretty much in conjunction with one another? Now, the way this is set up is it's a value from 1 to 0 to -1. The closer to 1 that this is means the higher correlation between those two assets, and the closer to -1, there's a negative correlation, and the closer to 0, no correlation at all. So all we're looking for is values that are as close to 1 as possible if we want to seek out two assets that are highly correlated with one another. Now, if you don't know what all this means yet, it's okay. Stick with me. I'm going to kind of walk you through it, and then I'm going to show you how I would actually apply this if I was to take a new liquidity position with two crypto assets. So just on a quick glance here, we can see, for example, Bitcoin and ETH. Hey, it makes sense, right? Kind of two of the OGs of crypto. They have a 0.92 correlation coefficient, meaning that they are highly correlated to each other. So when Bitcoin goes up, ETH kind of goes up. When Bitcoin goes down, ETH kind of goes down with it. Now, it's not perfect, right? It's not exactly. This measurement tool is really only a way to get a feel for more or less how things are correlated. We're not looking for exact answers. We're looking for statistical probabilities that position us to make more profit in the world of crypto and yield farming. Then I could say, hey, Bitcoin and Solana. Oh, look at that, 0.94. Very highly correlated. I could come over here and say, oh, look, Chainlink and Bitcoin, also very correlated, 0.93. Now, I could go through this whole matrix and find, oh, look, Cardano and AVAX are correlated. I could go, oh, look, ETH and AVAX are correlated at 0.86. I could go all over this place. again, it's just a tool to give you a snapshot of what's going on. So let's make this practical. Like, what would I actually do with this information? If I was a crypto investor and I was, say it like all I did was hodl, okay? I buy and hold long term, that's all. I bought a bunch of Bitcoin, I bought a bunch of ETH, I bought a bunch of Link, and Brandon, I don't want to like trade that and try to look at charts all day and play the market. I just want to buy and hold my crypto. Well, guess what? You're probably going to make money if you just buy Bitcoin and Chainlink, for example, and just hold it for 20 years. You're going to make you're going to make money, right? It's not guaranteed, nothing's guaranteed, but it's highly probable. Now, the flip side of that is, what if I could add to that long-term appreciation? What if I could add another somewhere in the range of 50 to 100% APY per year? Because you go, oh, well, 50% per year in crypto, that's not that much. But compound that over the course of 4, 6, 8 years, then it does start to get really good. So if I had a bunch of Bitcoin and Link and I said, hey, how could I actually add to my earning potential? So now I'm going to come over here. This is a tool called Aperture Finance. And if I want to, and this the example I'm using today, I'm set up on the Arbitrum network. Aperture is a tool that leverages Uniswap v3 that allows me to create concentrated liquidity positions. And I could come over here and I could just say, hey, I want wrapped Bitcoin and I want Link. Okay, so I would that's what I would make my pair that I'm going to put together and add to the liquidity pool. And then I can come over here. Now, here's the kicker. Here's why it matters. With concentrated liquidity positions, right now the market price is 25.57 Link per Bitcoin. The narrower I make this position, this liquidity position, the larger my cut of the trading fees within that range is going to be. Now, to fall out of range simply means two assets that normally would be aligned with each other, if one goes high and the other one stays there, or one goes high and the other one goes lower, meaning as the gap between them widens, I have a higher and higher potential of falling out of this range that I preset, which means if two assets stay in alignment with each other, even though they're rising or falling in value, my range is the same, and I can only earn trading fees while I'm in range. So the principle here is, how does asset correlation affect yield? Well, it makes it easier to get more yield, a higher percentage of the trading fees, by creating narrower ranges without risking falling out of range. If I pick two assets that are not correlated with one another at all, then they could go, one goes up, one goes down, or one goes up and the other goes up and goes down. Now, that just means that I'm going to fall out of range and I'm going to stop earning fees. I have to rebalance my position or take a different position. It just adds complexity to the system. And we want a system that is as simple as possible, because general principle of system reliability, if you add more complexity, you're going to reduce that system's reliability. So in the interest of as simple as possible, correlated assets, in this case, I'm just using an example. Hey, Bitcoin and Link, are they correlated? Well, according to this, they've got a 0.93 correlation coefficient. Pretty correlated, which means if I opened a position here, and let's just say I wanted to do, 0.1 Bitcoin, and now it's going to balance it for me. Say, okay, if you wanted 0.1 Bitcoin, it's going to cost you this much Link. Now I can open a liquidity position in this range and start to collect fees. And because they're correlated, it's not impossible. It's just less likely that I can fall out of range. Now, if you do fall out of range, you can simply rebalance. It's not a huge deal. It's just that by creating a tighter range in a concentrated liquidity position, you have the potential to earn a much higher portion of those trading fees. And like we talked about before, I want to land in this 50 to 100% APY per year on average range. This does not include the long-term appreciation of those assets. It's simply saying there's an opportunity right now in crypto to earn additional APY on top of whatever else that you are earning. And as long as you don't get greedy and don't shoot for 800%, 900% APYs, I know there's yield farming schools that teach that, chase the high APRs and all this kind of stuff. This is not that. All I'm saying is we set reasonable ranges, and then we use data. We use existing data of the market and how assets are correlated to select pairs that put us in a much better, more probable position in order to earn those higher fees long term. Okay, so That's all for today. I want to keep this short. I know this is a big topic. We could probably do like 10 hours of education just on correlations and how the whole thing works out. I like to make things super, super practical. If you want to talk to me, if you want to learn more about the mastermind and how we implement these kind of strategies, just drop a comment below. Say like, hey, yeah, send me info. Hey, I'm interested. I'll just pop into your messenger. I'll send you the info. Simple as that. You can kind of scope it out, see if it's for you. Otherwise, keep watching this space wherever you are in internet land. Keep watching this space. And there's going to be more of these videos popping up soon where I kind of guide you through some guiding principles of cryptocurrency investing and how they actually affect on a day-to-day basis, year over year, what your returns end up being. We'll see you next time.